Most people think the first inflation shock was the real danger because it was loud, obvious, and impossible to ignore. I do not see it that way. The first wave got attention because prices exploded all at once and everyone felt the punch at the same time. The second wave is more dangerous because it arrives after people relax, after policymakers declare progress, and after families, businesses, and governments are already weaker. That is when inflation stops looking like a headline and starts acting like a trap. If my way of reading these cycles helps you see what the crowd misses, keep this channel close, because what I am about to lay out is not about one bad month of data. It is about a system that still has the same deep pressures underneath it. I have spent my life studying debt, money, power, and history, and I can tell you that second waves do not feel like repeats. They feel worse because they hit damaged ground. When people hear the word inflation, many of them picture one simple thing. They think prices went up, the central bank raised interest rates, supply chains healed, and now the problem is fading. I understand why they think that. From a distance, it looks clean. But when I study big cycles, I almost never see clean endings. I watched U.S. inflation hit 9.1% in June of 2022, the hottest reading in about 40 years. That was the kind of number that forces everyone to pay attention. Then the rate came down. By the end of 2024, the Fed's preferred measure of inflation, called PCE, was running at 2.6%, and core PCE was 2.8%. Core just means it strips out food and energy, so I can see the trend more clearly. On paper, that looked like progress. In the real world, it was only part of the story. The part that people miss is simple. Inflation is not just about the speed of price increases. It is also about the level prices reached and the condition people are in after they get there. If prices jump hard for 2 years and then rise more slowly, life does not go back to normal. It just becomes painful at a slower pace. That is a very different thing from relief. I want to make that real. If a family's food bill, insurance bill, rent, car repair bill, and utility bill all move up sharply, that family adjusts. Maybe it cuts savings. Maybe it leans on a credit card. Maybe it skips a repair, delays a move, or stops taking small risks that might have helped it get ahead. By the time the official inflation number cools, the balance sheet is already bruised. That is why a second wave can do more damage even if the number itself is smaller. I have seen this pattern before in history, and history matters because human behavior changes far less than people think. The Great Inflation in the United States lasted from 1965 to 1982. It was not one clean burst. It had phases, false hope, and repeated pressure. Inflation surged in the 1970s, eased at times, then came roaring back, and by 1980 it was near 15%. What finally killed it was not a polite adjustment. It took brutal tightening, deep recession, and unemployment near 11%. That history matters because people love to remember the spike and forget the setup. They remember oil prices. They remember panic. They remember Paul Volcker raising rates. What they often forget is that inflation became stubborn because policy stayed too easy for too long, because officials wanted growth and employment, and because once inflation got into expectations, wages, pricing, and politics, it became much harder to remove. The second wave was not an accident. It was the cost of not finishing the job early. I am not saying this cycle will copy the 1970s line for line. History does not repeat exactly, but it rhymes with a precision that still surprises me. Today, many people think the first wave was mainly about supply chain problems, stimulus money, and energy shocks. That is true, but it is incomplete. The deeper issue is that the system beneath the first wave did not become healthy after the first wave passed. When I look under the hood, I see a debt problem, and debt problems change everything. The United States has to issue enormous amounts of debt to fund its spending. Debt is just borrowed money that must be paid back later. In early 2025, I warned that the U.S. had a severe supply and demand problem with debt. In plain English, that means the government has to sell a huge amount of bonds. but I am not sure the world will want to buy all of them at prices that keep the system stable. That is not some abstract concern I keep in a textbook. It changes the path of inflation directly. If the government keeps running large deficits, which means it spends much more than it collects, it has to borrow more. More borrowing means more bonds. More bonds mean buyers either demand higher yields, which are the returns paid on those bonds, or the central bank ends up playing a bigger role in keeping the market orderly. One path is painful, the other path can become inflationary. Sometimes both happen in sequence. The numbers tell me this pressure is not small. The Congressional Budget Office projected net interest outlays of about $970 billion in 2025 and more than $1 trillion in 2026. Net interest outlays are simply the government's interest bill. When I see a country spending over $1 trillion a year just to service past borrowing, I know the room to maneuver is shrinking. I also know political choices get harder, not easier. The same long-term projections show debt held by the public around 101% of GDP in 2026 and rising toward 120% by 2036. GDP is the size of the economy. So when I say debt is above 100% of GDP, I mean the debt owned by the public is larger than the economy's yearly output. That is not a normal place for a country that wants easy options. It is a place where every policy choice starts to lean on every other policy choice. This is why I say the second wave can hurt more than the first. During the first wave, people still had some buffers. Many households had leftover savings. Many companies still had strong pricing power after the rebound. Many investors still believe central banks had wide freedom to act. Now some of those cushions are thinner. Savings rates have fallen. Borrowing costs are higher. Governments are more indebted, and social patience is lower. Have I ever asked myself why people can feel poorer even while the official inflation rate is cooling? I ask that all the time because that gap between data and lived reality is where big mistakes begin. If that question matters to you too, stay with me because the next layer is where the pressure really builds. This is no longer just about prices rising, it is about the system that now has less capacity to absorb them. By 2025, the Fed could point to progress. In April 2025, PCE inflation had eased to 2.1%, and core PCE had slipped to 2.5%. That sounds reassuring until I look at what stayed sticky. Housing services inflation was still running around 4.2%. Housing services means the cost of shelter, rent, and related housing use. Even after cooling, that was still above the old normal. And then there is the part ordinary people feel every single week. The Fed itself noted that key consumer staples like food and energy necessities were still more than 25% above where they were before the pandemic. That matters enormously. If everyday essentials are up by more than a quarter, a lower inflation rate does not erase the damage. It just means the wound is no longer opening as fast. For families living month to month, that is not victory. Now, add the new structural pressures. I see tariffs, industrial policy, supply chain rewiring, defense spending, tighter labor in some sectors, and a world that is becoming less efficient and more suspicious. Tariffs are taxes on imports. They are often sold as strategic tools, and sometimes they are, but they also raise costs, disrupt sourcing, and push countries into retaliatory behavior. That is not a recipe for lasting cheap goods. I have said many times that when large powers move from cooperation toward rivalry, the economic system changes shape. Countries reshore production. That means they bring manufacturing closer to home for security reasons. They stockpile more. They duplicate supply lines. They spend more on energy resilience, semiconductors, and defense. All of that may make strategic sense, but it usually costs more, and higher costs tend to find their way into prices. This is where most people read the problem too narrowly. They think inflation is a consumer problem. or maybe a central bank problem. I see it as a whole system problem. It involves fiscal policy, which is government spending and taxation. It involves monetary policy, which is the central bank's control of money and interest rates. It involves geopolitics, labor markets, social psychology, and the bond market. When several of those pieces all lean the same way, the pressure becomes persistent. A lot of listeners will have a fair objection here. They will say productivity is improving, technology is moving fast, and artificial intelligence could bring down costs. I agree that technology can be disinflationary. Disinflationary simply means it helps slow price growth. Better software, better logistics, better automation, and better decision tools can absolutely reduce costs in parts of the economy. I do not dismiss that at all, but I have learned to ask a harder question. Can technology lower costs faster than debt, deficits, tariffs, aging infrastructure, labor shortages, energy shifts, and political fragmentation push them up? Sometimes the answer is no, at least for a while. A supermarket bill does not care that software got smarter if transport, insurance, rent, and financing costs are all still climbing. A factory does not become cheap just because code got better if supply chains are being rebuilt for security instead of pure efficiency. Do I really believe a second inflation wave has to hit 9% again to do more damage than the first? No, I do not. That is one of the biggest misunderstandings I see. If a second wave lifts inflation to 4, 5, or 6% while people are already exhausted, while rates are already high, and while debt is already heavy, the pain can spread more deeply. A smaller fire in a drier forest can still destroy more land. The reason is simple. The first wave shocks people. The second wave breaks confidence. During the first wave, many people still believe it is temporary. They think relief is on the way. By the time a second wave appears, that belief is weaker. Workers ask for higher wages. Companies raise prices faster because they expect their own costs to rise. Investors demand more yield. Consumers buy early because they fear waiting will cost more. The psychology shifts from patience to defense. That change in psychology matters because inflation is partly a mechanical process and partly a social one. The mechanical part is money, debt, wages, and supply. The social part is expectation and behavior. When people start to act as if inflation will persist, they help make it persist. That was true in the 1970s, and it can be true now in different form. Once the system starts protecting itself against higher prices, it quietly builds higher prices into the future. Another objection I hear is that the Fed can just do what Volcker did. In theory, yes, a central bank can raise rates hard enough to crush demand, but theory and practice are not the same when debt is this large. High rates do not just slow spending. They also raise the government's interest burden, pressure real estate, weaken weak banks, squeeze highly leveraged companies, and test political tolerance. So the medicine that worked before becomes much harder to use in full dosage. I want to be careful here because I am not saying central banks are powerless. They still have power. What I am saying is that the trade-offs are uglier now. In the early 1980s, the debt load was far lower relative to the economy than it is today. Now the country is dealing with larger fiscal strain, bigger asset markets, older populations, and a more divided political environment. That makes tough anti-inflation policy possible, but far more costly. And when I say costly, I do not just mean for Wall Street. I mean for workers, small businesses, housing markets, pension systems, and governments. I mean defaults, layoffs, and pressure on public services. I mean social tension. This is why I think many people are too casual when they say, if inflation comes back, the Fed will handle it. Maybe, but how cleanly and at what price? If you have ever felt that markets are not just driven by earnings and rates, but by something deeper and more political, you are seeing the right thing. Keep this channel in your circle, because this is where finance stops being a spreadsheet and starts becoming a map of power. The money system is never separate from the political system for very long. They always meet in the bond market. eventually. I also pay close attention to the world outside the United States because the second wave does not have to begin at home. A new energy shock can do it. A shipping disruption can do it. A broader tariff fight can do it. A serious military conflict can do it. So can a shift in reserve behavior, where major holders of financial assets become less eager to keep adding exposure to U.S. debt. When the world becomes more fractured, inflation becomes less local. That is one reason I have talked so much about changing world order dynamics. When trust weakens between major powers, trade becomes less smooth, capital becomes more cautious, and self-protection rises. Countries want strategic stockpiles. They want domestic capacity. They want control over technology, medicine, energy, and food pathways. These are rational goals in a dangerous world, but rational national decisions can still create a more inflationary global system. So when I think about what could happen next, I do not see one neat path. I see several. In one scenario, inflation stays sticky, maybe in the 3 to 4% range, while growth slows. That may sound manageable, but it quietly erodes purchasing power and keeps rates higher than people expect. In another scenario, a geopolitical shock or policy error pushes inflation back much harder, and central banks have to choose between recession and credibility. In a third scenario, growth weakens first, policymakers respond with easier money or larger deficits, and inflation returns after a short pause. Notice what all three scenarios have in common. The first wave is not the end of the story, it is the opening act. The system is still loaded with debt. The political appetite for austerity is low. Austerity just means painful cuts or tax hikes to restore balance. And the world is becoming less efficient at the very moment many governments need cheap financing the most. That is not the backdrop of a solved inflation problem. What do I do with that view in practical terms? I do not bet my future on one perfect forecast. I respect uncertainty and I build around it. I want resilience. That means I care about diversification, which is just spreading risk across different kinds of assets. So one bad outcome does not wipe me out. I want some liquidity, meaning cash or near cash, that gives me room to move. I want exposure to assets that can hold value if money loses value. And I never want to be forced to sell at the wrong moment. On a personal level, that way of thinking changes behavior. I keep leverage under control. Leverage means borrowed money used to amplify returns, and it can destroy people when conditions turn. I think carefully about fixed costs. I respect inflation-protected assets. I like quality businesses with real pricing power because a company that can raise prices without losing all its customers is stronger in a hard world. And I always remember that survival comes before optimization. Have I learned anything from decades of watching booms, busts, debt crises, and policy mistakes repeat? Yes. The biggest losses usually do not come from what people cannot imagine. They come from what people can imagine but decide to dismiss because the first round already seemed painful enough. That is exactly why second waves are so dangerous. People are tired of hearing about the problem before the problem is actually over. So when I warn that the second inflation wave could hurt more than the first, I am not trying to sound dramatic. I am trying to sound precise. The first wave raised prices. The second wave can hit confidence, policy flexibility, and social stability at the same time. It can arrive in a world with more debt, thinner savings, tighter margins, and less trust. It can force harder choices from governments and harder sacrifices from ordinary people. I have watched markets long enough to know that appearances can be comforting right before reality turns again. A cooling inflation chart can hide a damaged household sector. A strong stock market can hide fragile public finances. A calm month in bonds can hide a severe long-term supply problem in debt. That is why I spend so much time studying the underlying machine. Headlines tell me how people feel. The structure tells me what comes next. If I leave you with one practical thought, it is this: Do not prepare only for the inflation everyone remembers. Prepare for the inflation that returns when people have less strength left to fight it. Build room into your life. Keep some balance in your portfolio. Respect debt. Respect cash flow. Respect history. Because the most dangerous part of an inflation cycle is often the moment people start believing the danger has passed. I have seen this movie before, even when the actors and details change. The crowd cheers the slowdown, policymakers breathe easier, and then the deeper forces come back through a side door. By then, the system is more brittle. By then, every move costs more. By then, the second wave does not need to be bigger to do more damage. It only needs to arrive when people are least able to bear it. That is the pattern I am watching now. That is the warning I would not ignore. And that is why I would rather be early, calm, and prepared than comfortable for one more season. The market punishes denial long before it rewards hope.